Meet Marcus and James, both 30 years old, same job, same salary, same city. And after years of saying no to things, holidays they could not afford, cars they did not need, nights out they skipped, they both arrived at the same number. $45,000 saved. Marcus looked at that number and thought, down payment. He has always believed that real estate is where real wealth is built. Something physical. Something you can drive past on a Sunday and point to. Something that collects rent while you sleep, builds equity while you work, and grows in value while you live your life. To Marcus, property is the oldest wealth-building tool in history. Kings owned land, billionaires own buildings. He wants a piece of that. James looked at the same number and thought, portfolio. He believes the stock market is the most powerful wealth-building machine ever created. No maintenance calls, no tenant disputes, no leaking roofs. Just money quietly compounding in the background while you get on with your life. To James, stocks are not just an investment. They are ownership in the greatest companies on earth. And over time, the market always goes up. He is happy to wait. Both of them put $400 a month from their salary into their investment. Same discipline, same amount, same starting point. The only difference is where the money goes. Marcus puts everything into property. James puts everything into stocks. 20 years later, they sit down and look at what they built. And the result is not what either of them expected. If you would like to support the channel, subscribe now and turn on your notification bell, because you might not find this channel again, and you do not want to miss what is coming next. Marcus finds a $225,000 rental property. 3 bedrooms, decent neighborhood, strong rental demand in the area. He puts down his $45,000 as a deposit, borrows the remaining $180,000 at 7% over 30 years. That is his monthly mortgage payment. He finds a tenant quickly. $1,950 a month in rent. Most people hear that and immediately do one calculation. $1,950 minus the mortgage. The mortgage on $180,000 at 7% over 30 years comes to $1,198 a month. That leaves $752, and most people stop there and call that profit. It is not profit. It is a starting point. Because that $752 still has jobs to do. Property tax, $2,200 every year. Buildings insurance, $1,100 every year. Maintenance, things that come up every year. Small repairs, upkeep, wear and tear. Another $2,250 set aside every year. And 1 month of vacancy every year, because no property stays occupied forever, and when a tenant leaves, the mortgage still has to be paid while Marcus finds a new one. That is another $1,950 gone. Add all of that up across 12 months and spread it monthly. The real costs of running the property come to $625 a month. Subtract that from the $752 surplus. What is left is $127 a month. That is the honest net position after every real cost is counted. The property is paying for itself, just barely. And from his salary, Marcus puts $400 a month into a property reserve account. Money sitting ready for the day the boiler breaks or the roof needs attention. That $400 a month is his contribution to his investment, just like James's $400 a month going into stocks. This matters. Because Marcus is not subsidizing the property from his salary every month just to keep it running. The property stands on its own. His $400 is separate, a buffer that protects the investment. James the same week puts his $45,000 into a total stock market index fund. $400 a month going in automatically from his salary. He picks a fund that tracks the entire stock market, not individual companies, not hot sectors, just the whole market. Closes the app, gets on with his life. Both men are contributing the same amount every month, both living on the same amount. The only difference is what their $400 is building. For the first couple of years, Marcus feels like he made the right call. The rent comes in every month. The property is paying its own way. His friends ask about it constantly. How is the tenant? How much are you making? Could you buy a second one? Marcus has answers for every question. He likes having answers. James has a quieter experience. He checks his portfolio every few months. Sometimes it is up, sometimes slightly down. Nothing dramatic, nothing worth mentioning at dinner, just a number in an app that barely seems to move. From the outside, Marcus looks like the successful investor. James just looks patient. 3 years pass. And then Marcus sits down with a notepad and does the maths properly for the first time. Marcus looks at his equity. The property has appreciated since he bought it. His mortgage balance has fallen with every payment. That is what his reserve account has grown to. That is his total position. Now look at James. 3 years of $400 a month going into the market. The two numbers are close. But Marcus is ahead. Not by a small amount. Meaningfully ahead. And the reason is leverage. Marcus used $45,000 to control a $225,000 asset from day one. Every time that property increased in value, his equity grew on the full $225,000. Not just on his $45,000. James's $45,000 only grew on itself. That is the fundamental difference between property and stocks in the early years. Property gives you leverage. Stocks do not. Leverage is the reason property has made more ordinary people wealthy than almost any other investment. You put in £1 and you control 5. When the asset goes up in value, all £5 appreciate, not just the one you put in. Think about it this way. Marcus put in $45,000. But from day one he was sitting on $225,000 worth of asset. When that property went up in value by 4% in year 1, he did not gain 4% of $45,000. He gained 4% of $225,000. That is $9,000 of growth from a $45,000 investment. A 20% return in 1 year without doing anything. James gained 4% of his $45,000. That is $1,800. Same year. Same market conditions. Marcus made 5 times more from appreciation because of leverage. That is why Marcus is ahead in the early years, despite James investing just as consistently. But leverage cuts both ways. If the property market falls, the losses are also multiplied. And managing a property is not like managing a stock portfolio. You cannot close the app and forget about it. Tenants move out. Repairs arrive unexpectedly. The property needs attention. Marcus manages it himself, which saves money but costs time. His evenings and weekends are occasionally not entirely his own. None of that shows up in the equity number, but it is real. James, meanwhile, has answered 0 calls about anything. His investment runs completely without him. 5 years in, Marcus has been through 1 full tenant change. The property needed a minor roof repair in year 4, $900 taken straight from the reserve. No panic, no credit card, just the reserve doing its job. Rent has increased slightly as the market moved. The property is still paying for itself. And the equity keeps building. That is Marcus's total position at year 5. James has not changed a thing. $400 a month, every single month without missing once. That is his portfolio at year 5. Marcus is still ahead. The leverage advantage is holding. But James is consistent, and consistency over time becomes very powerful. In year 7, James notices something when he checks his account. The market added more to his portfolio that year than his own monthly contributions did. For the first time, the money is growing faster than he is putting it in. This is what compounding looks like when it starts to accelerate. The first few years feel like almost nothing is happening. Then the growth starts producing its own growth. And every year after that, the curve gets steeper. Marcus, at the same point, has his equity growing and his reserve building. Still ahead, but the gap is narrowing. 10 years. Marcus's property is worth significantly more than he paid for it. His mortgage balance has fallen substantially. Every single month for 10 years, the tenant paid rent. Every single month, the mortgage reduced. Every single month, the property appreciated. Three forces working together quietly in the background. James has had 10 years of consistent monthly investing. He has never once changed what he is doing. He checked the account when the market dropped and felt his stomach drop with it. But he did not sell. He kept the transfer running. He woke up the next morning and went to work, and the market recovered, and then went higher. When you put both numbers side by side at year 10, Marcus is still ahead. The leverage he got on day 1 is still working in his favor, but James is closing the gap, and compounding does not stop. Before the final numbers, two things need to be said honestly about stocks. The return used here is the long-term historical average of the total stock market. That average includes years of serious loss. In 2008, the market fell nearly 40%. In early 2020, it dropped over 30% in weeks. If James had watched his savings collapse and sold, which is what most investors do in that moment, his final number would look nothing like what you are about to see. Holding through a crash is one of the hardest things an investor has to do. Most people say they will. Most people discover they cannot when the moment arrives. About property. Everything in Marcus's story assumes he found a property where the rent covered all the real costs. Not every property does that. Many investors buy a property where the rent barely covers the mortgage, let alone the taxes, insurance, maintenance, and vacancy. Those investors are subsidizing the property from their salary every month without realizing it. And it assumes Marcus was willing to manage the property actively, to be there when things needed attention, to treat it like the business it actually is. Property is not passive income. It requires involvement. Marcus's property has nearly doubled in value since he bought it. His mortgage balance has fallen dramatically. James has had 20 years of $400 a month going in without interruption. Now look at both numbers side by side. James won on the final number. The stock market overtook the property in the final stretch. For 15 years, Marcus was ahead because leverage gave him a head start from day 1. But in the end, compounding caught up and passed him. James finished with more. But Marcus arrived at year 20 with something different. A tangible asset he can sell, refinance, or pass on. 20 years of rental income that paid for itself. And the knowledge that his property covered all its own costs while his $400 a month built a reserve on top. James finished with a larger number. Marcus finished with an asset and a story. Neither of them made the wrong choice. After 20 years, the honest answer is this. Stocks produced more wealth in this comparison, but property produced income, leverage, and a tangible asset that compounding alone cannot give you. And here is the thing most comparison videos never say. The reason James won on the final number is not that stocks are always better than property. It is that compounding over 20 years is an almost unstoppable force once it gets going. In the early years, leverage beats compounding. Marcus was ahead for 15 years, but in the final stretch, compounding caught up and overtook him. That is what happens when you leave money in the market long enough. The question is not which one wins on paper. The real question is, which one suits the investor you actually are? If you can find a property where the rent genuinely covers all the costs and you are willing to manage it properly, property gives you leverage that the stock market simply cannot match. In the early years, you will be ahead. You will build equity on a much larger asset than you personally funded, and you will have something tangible to show for it. If you can invest consistently and hold through a crash without selling, stocks will build serious wealth with almost none of the effort. You will not be ahead in the early years, But stay consistent long enough, and compounding becomes one of the most powerful forces in personal finance. Both paths require discipline. Both paths require honesty about the real numbers. And both paths lead to real wealth when followed properly. The worst outcome is not choosing one over the other. The worst outcome is choosing one without understanding what it actually demands from you. Both reward the same thing: patience, consistency, honesty, for 20 years. If this changed how you think about building wealth, subscribe to Marcus Finance now and turn on your notification bell, because you might not find this channel again. You do not want to miss the next video.